AMPL is actually a decentralized, fully algorithmic unit of account. And it has a very simple protocol. And for this reason, you can start to use it as a decentralized building block.
Hello, everybody. My name is Ben. I am an analyst from CoinGecko. And for today's podcast, I will actually be having Evan Kuo, the founder of Ampleforth, today on the session. Hi, Evan. If you could just say hi to everybody.
Hey, everyone. It's great to be here. I'm a big fan of CoinGecko, one of the more reliable places to get information about coins. Thanks for having me.
Yeah, sure, no problem. So just a reminder before we get into it, if everyone could like and subscribe, that'd be great. Thank you. Well, let's just get right into it, right? So Evan, before anything, right, we always ask our speakers, how did you get started with crypto,
Yeah, I mean, that's a good question. I guess, my background originally is in engineering. I went to UC Berkeley, and I think I was working at a startup, and somebody had, this is a friend of mine who is more libertarian in his political views, got really excited about the Bitcoin paper. And I remember reading it and I guess thinking about it, and I kind of walked away with two thoughts. One, this is a very unscalable design. So it's like, why would somebody design a system like this? And two, this is, this is difficult to understand, and it's also fixed supply. Like, why didn't we once have a gold standard? Like, aren't we away from fixed supply? Why would we want to go back in time, go back to something like that? And so I was a little bit, skeptical that it could be adopted because it was so complicated to understand, it seemed, right? And also didn't seem very scalable, right, from a technical design perspective. But the thought continued to evolve in the back of my head as I kind of just went back to daily life and would check in from time to time to see like what had changed, right? How had the universe evolved with respect to Bitcoin? And it became clear to me that it was designed in this so-called unscalable way because it needed to be censorship resistant, right? In the past, anytime somebody tried to introduce something that was like a non-sovereign, currency, even things like the Liberty Dollar, it had been quickly regulated and shut down. And so they had to give up a lot of technical scalability for this social scalability, right? And for this censorship resistance. And then the other thing that stuck with me over time is that there really was a bit of a breakthrough here in the sense that the Bitcoin protocol was successful in creating scarcity in a purely digital context. So prior to that, I don't think I had seen any other example of scarcity in the digital world. Every file is already a copy of a copy of a copy. An image, by the time it gets to your browser, has been replicated by CDNs. There is no scarcity on the internet, and then all of a sudden, the Bitcoin protocol, well, by maintaining this kind of universal record, they have created scarcity in a purely digital context. And so that was my introduction to crypto. Those were the two thoughts that kind of stuck with me. And, eventually I met up with my co-founder, Brandon Isles, who's also an engineer, but he was working at Google when I originally met him on search. And then eventually at Uber, he had been following crypto independently as well. And we were starting to get a little bit more excited about the launch of Ethereum and what could be done now that you have this kind of programming platform. Like, it was an invitation to create a new type of asset. And so we went down this journey of like, well, what types of assets ought to be created? And that was not as obvious as it might sound. So that's how I got into crypto.
So yeah, I guess you already kind of gave us a hint about where Apple will actually be. So you mentioned about how you found that there were a lot of scalability issues, and then you also questioned fixed supply rates, which really blends in well to the next question, right? So what is AMPL or Ampleforth?
Right. So AMPL is actually a decentralized, fully algorithmic unit of account. And it has a very simple protocol. When the price exchange rate of AMPL to the US dollar is over 1, the protocol automatically increases the quantity of tokens across all user wallets proportionally. And when the price exchange rate of AMPL is less than 1 US dollar, it proportionally decreases the quantity of tokens across user wallets. And this protocol has the effect of translating or transferring the volatility of demand from the price per token to the quantity of tokens in user wallets. And for this reason, you can start to use it as a decentralized building block. And, I'll note that we now have kind of about 2.5 years of live market data observing kind of AMPL in action. And you could basically say that this simple protocol has the effect of separating the asset's price volatility distribution from its stock volatility distribution. So AMPL has this kind of mean reverting price, right, where it's kind of normally distributed around the target value of 2019 US dollar, but it has this kind of fat-tailed stock volatility that's common to equities and cryptocurrencies and such. And so by kind of separating its price volatility from its stock volatility, you can start to denominate stable contracts with AMPL. And unlike a stable coin, the AMPL does not seek to eliminate volatility. It just kind of transfers volatility. And for that reason, it's like kind of unbreakable. So, and also a bit more censorship resistant. It doesn't rely on collateral. It's fully algorithmic the way Bitcoin is. And it's also unbreakable in the sense that like natural market forces, like a sudden increase in demand or decrease in demand, can't really cause it to break. That I think is really important from the perspective of a building block, especially based on what we've seen from other decentralized approaches just in the past couple of years.
Okay, so I taking a step back, right? You kind of explain what AMPL is, and effectively, AMPL is a form of stablecoin, right? So
no, it's actually
would you classify it as that?
No, because it's not stable. So
Yeah.
it has right. So people always really, really want to call us a stable coin because that's something that's very well understood in the industry. There are floating price tokens and there are stable coins. And because AMPL has this price target, people really, really want to call it an algorithmic stable coin. But I don't call it that. I really don't believe that it is because it's not stable. So it's not a refuge from volatility. If you were to hold AMPL and the market demand for AMPL increases 1,000-fold, the value of your stack would multiply by 1,000. You would just have more units, each approximately worth $1, versus a stable coin where we've seen the market cap of USDC grow to something like 40 billion over the course of the last year. Holders of USDC didn't see massive returns. Similarly, if the market cap of USDC decreases, they don't lose money. It's a refuge from volatility. Whereas AMPL is actually a unit of account, meaning it can be used for contract denomination. And I'll give you a really quick example of this. Like, imagine you wanted to borrow, let's say, $2 million worth of value to purchase a house over a 30-year mortgage. And let's just say you did this 10 years ago and you denominated it in Bitcoin. You're like, I'm going to borrow 10,000 Bitcoin to be paid off over the next 30 years. And I'm going to start making these mortgage payments in Bitcoin. Well, cut to today, you'd be 10 years into this 30-year mortgage and on the hook for, $30 billion of Bitcoin or something, right, to be paid off. You would never want to denominate a long-term contract like that with an asset like Bitcoin, because if it suddenly appreciates quite a bit or depreciates, that changes kind of your debt obligation. And alternatively, with something like AMPL, you could denominate such a contract, right? If AMPL existed 10 years ago and we denominated a 2 million AMPL loan and we were 10 years into it, you would still really be on the hook for that 2 million AMPL, which is approximately $2 million over time, even if the market cap of AMPL were to profoundly grow or shrink. So what's important about it is it can be used to denominate contracts in spite of secular increases and decreases in demand. And the other thing that's really important about it is its durability. It cannot really break. So like Bitcoin, although Bitcoin is unbreakable, it can't be used for contract denomination. So AMPL is similarly unbreakable, and it can be used for contract denomination. And now we're starting to see that really basic use case take place on decentralized platforms like Aave. But there's far more to come, and I'm happy to talk to you about that. But I did want to clarify the difference
Yeah,
between a
sure.
unit of account and a stable coin.
It's very interesting, right? Because I mean, even like for me, like I generally tend to equate unit of accounts. Oh, you're a stable coin, right? But as you clearly showed, there's a subtle difference, which is quite distinct. So I guess, the next question comes, right? So what separates AMPL from other unit of accounts / stablecoins or stablecoins?
Well, I mean, I don't think there are any other unit of accounts, so to speak, that are like that have decided to isolate that function of money from the other functions. So it's funny, we tend to think of money as just this really well understood thing, like the dollar, right? Which is a unit of account. It's a medium of exchange. It's a store of value. And so anything that resembles the dollar is, what we call money. But I would say there's really nothing. There are no other projects that have decided to focus so much on just this one particular function of money. And for this reason, almost all of the other stablecoin attempts are either very easy to regulate because they're centralized. Fundamentally, they have kind of traditional assets in their collateral, or very unreliable because they're using cryptocurrencies as collateral, or they're using debt issuance like bonds and such. And I think a successful stablecoin would be one that is largely kind of independent from regulation, right? Just kind of decentralized, right? But also robust, something that can't really break by natural market forces. And so, typically when I think of stablecoins, I think of them existing in three common approaches. One is the traditional centralized stablecoin, right, which is easy to regulate. And then when I think of decentralized stablecoins, I think of another set of common approaches. One is the bond token approach, where you issue debt to be paid off in the future when the network grows, to facilitate a contraction. There are crypto collateralized approaches, which are vulnerable to the underlying collateral, and there are fractionally collateralized approaches, which are even more vulnerable to the underlying collateral. And so with the debt-based approaches, it's very straightforward for me to say that these sorts of bond or coupon tokens, they struggle in surviving secular decreases in demand. So imagine that you first have, let's say, a $1 billion market cap, and all of a sudden the market shrinks to the point where there's only demand for 500 million, and you issue kind of bonds, right, to be paid back at some point in the future when the market cap stretches back to that former high watermark value. Now imagine that it doesn't stretch back to that high watermark value for a very long period of time. These debt-based approaches kind of at that point magnify instability because the value of the bond kind of really erodes over time, and secular decreases in demand kind of occur naturally in all markets. And so that's the fundamental flaw. And really they borrow this debt-based kind of approach from more centralized, like central banks, right? Which are very different because, if you're a sovereign money authority, then, you have a monopoly. You can bail it out, right? You have the ability to bail out these systems, but as a decentralized system, there's no one to bail you out and you don't have a monopoly. And so if people kind of lose faith in the debt, the system kind of falls apart. So, I mean, we've seen examples of this, like Basis Cash, Elastic Set Dollar, Fei, all of these have, that flaw. With crypto collateralized approaches, this is slightly more promising because there's some kind of collateral in there. But if the collateral is fully decentralized, and say it's ETH, right? In the example of DAI, you can kind of look back to Black Thursday, when cryptocurrencies that supported that collateral fell in value, the system, really started to fall apart. And since then, they've just rotated in USDC as a collateral, which is just a traditional, asset. So you've got this decentralized stablecoin that's just collateralized by a centralized stablecoin. And so, obviously that's not ideal. And, there are promising futures. I think that eventually purely on-chain collateral can become much more robust and be rotated into these solutions as an alternative to USDC. But as it stands right now, it's not ideal. And lastly, I would say the fractionally collateralized approaches are similarly vulnerable to volatility of the underlying collateral, right? So, again, if you're only promising 50% collateralization instead of 150% collateralization, and it's all ETH and ETH price crashes, you're even more vulnerable to your collateral. So that's how I see the landscape today. It's really either something very centralized and easy to regulate, or something highly unreliable. And we kind of understood this when we were designing AMPL. We were like, we want something that actually can't break, but advances the space, right? So what can't Bitcoin do? What can't ETH do? Well, they're vulnerable to unit price volatility, and that undermines their ability to be used for contract denomination. And if we are going to build this decentralized alternative to traditional finance, we're going to need to be able to denominate basic contracts in a robust way. And that's how we got to AMPL, which is a simple unit of account, but its simplicity is its strength. It can't break by natural market forces.
So I'm just going to jump a bit here, right? Because you mentioned that, you categorize the different the stablecoin landscape is quite interesting, because a lot of them effectively, they try to peg themselves at $1, right? But then there's actually a bunch of products coming out. The one I have in mind is actually Ray, who classify themselves as stable assets. And they kind of, they have a floating peg. They don't peg themselves to any dollar. And they are focusing more, it's not really a unit of account, but more like a collateral. What are your thoughts on this, right?
I mean, in general, I'm a fan of this unbundling of functions of money, because I think attempting to solve all the problems at once leaves you in a very unreliable space, right? Like I said, with central bank systems, there's a sovereign monopoly that allows for certain things to kind of work that wouldn't work in a purely decentralized context. And so when you mention things like RAI, which cannot be used as a stable unit of account, like maybe you don't want to denominate a contract in something like that, right? But it is a bit of a refuge from volatility. Now, I think it kind of just dilates time, so to speak. And that's an interesting thought there. I think that the way we see the future unfolding is actually pretty interesting, and I'm willing to share that too, in terms of getting closer to a safe asset collateral. So if you can follow this kind of simple thought, it's that these assets like AMPL and Bitcoin and ETH, they have this underlying volatility to it, right? And what I think needs to happen next is we need to create methods of resegmenting that volatility. And I'll give you a really simple example of it. You can just imagine AMPL. It has these supply changes, right? And you can create a derivative or a set of derivatives that say, let's just say 90% of, you deposit AMPL into a contract, 90% of the supply changes will go to this bond, right? And it'll be almost hyper volatile in supply. And 10% will go to this bond, which will be, almost like deleveraged, less volatile than the original AMPL, right? By resegmenting the underlying risk of something like AMPL into, junior and senior tranches respectively, you can produce the combination of a leverage instrument and a safe asset. And that safe asset can be used as collateral by the issuer of a crypto collateralized stablecoin. You could imagine someone like DAI rotating out a little bit of their USDC for a safe asset, which is just a claim on the underlying volatility of another asset. And so I really think that this kind of layer that resegments the underlying risk of purely on-chain currencies into tranched bonds can then provide the building blocks of kind of safe asset collateral that would allow us to create a robust and decentralized crypto collateralized stablecoin. So in that way, AMPL is, a really good input into that system because, well, then you could do all that tranching on the application layer without any sort of oracle risk, really, right? Because, you're creating a derivative ultimately, and a derivative is just a special type of financial contract that connects with an underlying asset. And with something like AMPL as an input, it's already built for contract denomination. So like I said earlier, the simplest use case of a unit of account like AMPL is, debt denomination, which we see kind of taking place on Aave. Makes a lot of sense to kind of lend and borrow AMPL. But the next really kind of interesting grouping of functionalities is, for the denomination of derivatives. And these derivatives can be used to resegment underlying risk such that you can produce a very transparent and robust safe asset, which then could be the collateral for crypto collateralized stablecoin. So that's my long-winded way of answering like how we kind of connect the dots from something that's an unbreakable unit of account that can only be used for contract denomination, but not as a refuge for volatility, into a safe asset that can really do both. It requires this kind of in-between refinement process, not unlike refining crude oil into gasoline and kerosene, and then being able to use the gasoline and putting it into a car to drive it, right? I think if you ask too much and you say, well, I simply want to be able to dig into the ground and take that black petroleum, put it into my car and drive it, and I'm going to put all of that work into the engine of the car, you're setting yourself up for disappointment. And that's what we see with a lot of these more verticalized approaches to complex, stablecoin systems. What's missing is a simple refinement process. It's very analogous.
Yeah, exactly. I was just thinking this analogy is actually perfect. It gives a very good overview of what the problem and the solution kind of is. I think it's very interesting, right? So, okay, let's take a step back, right? So we understand that Ampleforth, it's supply driven, right? And you actually, if I have 900 Ampleforth today, I may have 1,000 Ampleforth tomorrow, or 800, right? So there's basically the coins are burned or sent to my wallet. So right, is something like that. And this is where actually I want to ask about the technical considerations, right? So how does this work, right? Well, for example, if Ampleforth is on an exchange, can that happen? What are how does this work?
Yeah, one of the key technical innovations here is that the Ampleforth protocol allows us to increase or decrease the quantity of tokens in user wallets without a transaction between peers. So because of the beauty of smart contract programming platforms, the manner in which we increase and decrease, or not we so much as the protocol increases or decreases the quantity of tokens, is by adjusting a scalar global variable. You can think of it as a coefficient of expansion, right? So they increase that coefficient, then the number of units across all wallets increases. They decrease it, the number of units across all wallets decreases. And this is actually one of these things that really could not have been made possible without, these layer one platforms and smart contract programming platforms. You can't really imagine executing a policy like this in a fiat paper world. Like, how are you going to coordinate the burning of everybody's paper money and then airdropping, new paper money to people's wallets? It couldn't have been really executed in any way. But with kind of the infrastructure that we have today, it can. And that's what allows the policy to work. Because if we had to, actually transact to all of our holders, that would be prohibitively expensive from a gas perspective. It would take a long time. And, obviously we wouldn't, how would you reverse airdrop, hundreds of thousands? You can't really do that. So it really is kind of the nature of that global scalar coefficient of expansion that makes it possible.
Yeah, I mean, that's really cool, right? It's only possible with smart contracts. Okay.
Yeah.
Um,
It's
so,
cool to do
so,
things that can only be done with blockchain
right,
technology. Yeah, so
I
many
know.
things that we see happening, like we could have done that with a simple bank, or we could have done that with this, centralized
Right,
server. We could have done that, you know, 50 years ago, but there are a few things that simply could not have been done until now.
right. Okay, so kind of taking a step back into like the stablecoin ecosystem, right? So as we all know, the stablecoin system slash unit of account, it's incredibly competitive, right? It's often decided by liquidity, mining incentives. So, is this a sustainable way of increasing adoption, right? And if not, how else can we improve this? And, we normally always think about the crypto world, but
Yeah.
then again, how do we actually bring this adoption outside crypto to the everyday life of regular non-degens?
Yeah, I mean, I think about this a lot, or I get asked this a lot, like when will we be spending crypto instead of dollars, right?
Yep.
Um, I I think that it will take time. I mean, what's being created with decentralized finance is almost like a global public infrastructure for finance, right? And just because it's global and digital and public doesn't mean it's better than the centralized analog, right? So imagine like another analogy is like imagine that you live in a country with really fast internet, but there exists this kind of free global internet as well. Um, if you have fast internet, you should just use fast internet, right?
Right.
If you don't, you'd be very kind of wise to tap into this free global infrastructure, and its very existence would pressure kind of your government to create a reasonably fast internet, or in order for it to kind of have a position in that marketplace if it wants to, right? Or if you have internet access that's highly censored, but fast, maybe you'd want to use this global public internet for access to kind of censored information or whatever. Just its existence creates a little bit of competitive pressure. And I think decentralized finance is like that as well. I mean, the hope is that we can create some sort of viable alternative to the traditional system. But, in the early days, it's going to be like, the free, PBS version of finance. What is cool about it, though, is there's also a lot of speculative interest to it. So most people purchase cryptocurrencies because they're looking to diversify their portfolios, or they want to have a position in an asset class that they believe to be growing, or they want to kind of join a cause that they think is valuable. And I think that the primary kind of vehicle for adoption in first world countries like the United States of cryptocurrency is going to be driven by speculation and portfolio management, because we do have a basic banking system and access to kind of stable currencies. And I think if anything, it's like, okay, there's a bit of inflation pressure. How do I kind of check against that? Well, I'm going to buy some stuff. I'm going to buy some equities. I'm going to buy some cryptocurrencies. I'm going to buy some commodities. I might even buy luxury goods, right? I don't want to sit on a
Yep.
bunch of cash because I'm worried about some inflation, and that will be the first exposure, I think, to cryptocurrencies for most people. With stable coins, I see a lot of adoption taking place just within the universe of crypto, right? Like I said, all lending and borrowing is pretty primarily denominated in centralized stable coins. I think that obviously with regulation around the corner, we might see kind of a little bit of fragmentation there. But there's a lot of people who also just understand that it's important to kind of start to use these decentralized systems. And in the case of Ample, there are actually really interesting speculative quirks, right, to lending and borrowing and building with this asset. I think for a lot of these existing projects who already have USDC in their kind of collateral, a decentralized kind of alternative safe asset would be a natural fit, in that it is a very competitive space. There are many kind of there are just two really successful centralized stablecoins, to be clear. There's Tether and there's USDC. They're kind of dominating. There's this kind of, broader menu of decentralized, so-called decentralized stablecoins, many of which have crypto in their collateral, right? Many of which have USDC in their collateral. And it's always kind of like a black fly in the soup to be like, we're claiming to be this decentralized stablecoin, but we have USDC in our collateral. I think that a good safe asset, like the one I described earlier, like a derivative of something like AMPL, could be the friend of all of these existing crypto collateralized stablecoins in a non-competitive way. They could start to rotate out their traditional assets, which are kind of something they have to wave their hand and explain and say like, okay, this is temporary. We're eventually going to put something else in here. And yeah, I mean, and then variety is good, right? Having a lot of options, a lot of choices is what crypto is all about. I mean, money has been a monopoly forever since its inception. And so this is the beginning of choice. And so I think there are very clear kind of economic hurdles that need to be solved along the way, but eventually these safe assets will kind of just percolate into the background. I can even imagine some of the centralized stablecoins one day adopting on-chain safe asset collateral as an alternative to just normal banking.
Yeah. Okay. I mean, really insightful piece, right? So, okay, moving on. Recently there's a lot of us have been talking about the US Congress hearing, right? There was a lot of it was, I think, about a 6-hour session, and they discussed a lot of different things. And it appears that the regulators are very concerned about stablecoins, particularly about the impact they will have on the country, right, in the US. What are your thoughts on this within the wider global context?
Yeah, I mean, I think in terms of stablecoin risk propagating into the broader global context, I mean, if it's centralized and it can be regulated, it probably will be, and they're asking for bank-like regulation. That's just something that we've expected from the beginning. I mean, like I said, when I was first introduced to Bitcoin, I was like, how could they design a system so unscalable? And the answer was because they knew the regulation was inevitable and they had seen it. And so it actually surprises me today that folks are surprised to hear about stablecoin regulation, because it has been the historical precedent for so long. The interesting thing that I remember hearing was this concern about a concentration of economic power around stablecoins, because they know they can have such powerful network effects, particularly when they're used for international trade agreements. These people are very smart, and they understand the risks of that. And if what that means is they're going to start limiting the size of centralized stablecoins, or having kind of a finger on the pause button so they can freeze assets or inspect assets, then yeah, that will change a lot of things, I think. But in general, all to be expected. This is why we wanted to build a more robust and decentralized solution. And I think this is why many people have sought to build robust and decentralized solutions.
It's quite interesting, throughout the conversation, the vibes I get from the witnesses themselves. They were trying to kind of reassure the US regulators, we are actually using USD to back our stable coins. So this is actually good for the US economy.
It's true. It probably, if anything, it'll accelerate, kind of dollarization to some extent. But yeah, I mean, defanging the whole thing is probably a good approach.
Yeah, I thought it was quite smart. But anyway, right? So, this brings me back to stablecoins and fiat currencies, right? Do you see stablecoins or replacing fiat currencies completely? Is there room for both to exist? What about other stablecoins, other decentralized or centralized stablecoins?
I've kind of always held the opinion that for a very, very long time, both will both will exist. I mean, I kind of see this as following very simply from a Hayekian thesis on competitive monies, right? Where, I mean, if you have read this, denationalization of money, I mean, he proposed two things. One, which is to open up the free trade of money, which is in a way allowing, people of one country to use the currency of another country if they see fit. And the other thing that he proposed was to allow the issuance of independent money, so the kind of private issuers could also circulate money. The net effect of that, I think, would be that you would lift the floor of the quality of money, in the sense where, like, if your country's money isn't really desirable, and people can choose to use the money of another country, then your country has to kind of pick up the slack and execute better policy in order to compete. It lifts the floor, raises the floor to the level of the best sovereign money.
Right?
And yeah, and allowing the issuance of independent monies has the potential to raise the ceiling, right? Where, like, because nobody has to use any independent money, it would have to compete on its basic merits, or it wouldn't exist. And eventually you would just see that lift all boats, and money would be better at kind of providing optionality, which is its main purpose. I think with crypto, it's slightly different, because nobody's opening the free trade of money willingly. These are all kind of independently issued monies, and there's just kind of this global slow infrastructure, if you will, being created, and it'll be used as a currency when there's no better option. And could it one day kind of lift the ceiling? Yeah. But do I think that fiat money is going away? No, I really don't. I think that it's going to be around for a very long time, and I think that's okay. I think the very presence of optionality is the point.
Well, we talked about different topics, right? And I think we come back a bit to Ample, right? So the last question for today is, what are Ample's plans for the next 5 years? You have a lot of ambitious goals, I assume.
Yeah, I think so. I think one obvious thing is we're moving horizontally across the stack, where from one chain to another, so that it can be used as a unit of account. But I think perhaps more interestingly, the movement up the stack, right? Where at the base level you have this unit of account, right? And its first use case is debt denomination, right? Its next use case is the denomination of derivatives, the output of which could be safe asset collateral to be used in the reserves of decentralized stablecoins. At that point, we will have greatly evolved the infrastructure of crypto as we know it, to be in a situation that could be, robust. And so, we're really kind of starting to stimulate development on top of AMPL, where you kind of assume that the base asset is also a unit of account. And so, yeah, there are some interesting projects in that word, in that kind of vector that we're actively stimulating. So horizontal movement, vertical movement, but really we're in the next 5 years, we're hoping to get, all of cryptocurrency from 13th century Venice to 18th century England, as one of my academic advisors, Manny, often says. So it'll be, it's kind of like an Operation Warp Speed. How do we go from 13th century Venice to 18th century England in 5 years? Talk to Manny.
I mean, crypto, that's very normal, right? Everything is exaggerated and exponential.
Yeah.
Okay. Thank you so much, Evan. Do you have any last words, for our viewers and audience that you'd like to share about Ample or anything?
Yeah, I mean, I think just feel free to reach out to me if you have any questions, and visit ampleforth.org if you'd like to learn more about the project.
Okay, thank you so much, Evan, for coming on board today. It was great to have you.
Yeah, thank you.
Thank you.
This podcast is provided as part of the overall information on cryptocurrency contained on our website, is for your general information only, and does not howsoever constitute any endorsement, financial or investment advice, nor any solicitation or offer of securities or other financial instruments. CoinGecko and the podcast presenter makes no warranties, implied or express, of any kind in relation to this podcast, including, without limitation, the accuracy and updatedness of its content. All opinions and recommendations there in the podcast are based on the personal opinion of the presenter. Please conduct your own research and procure professional advice should you, at your own risk, decide to howsoever invest or trade in relation to the content contained in the podcast.
For the latest crypto prices, visit our website. If you haven't already, make sure to subscribe to our YouTube channel to keep up to date on the latest crypto trends.